Okay, let's move on to the third note then. So, note 3, Diamond has owned a 25% equity interest in Hart for a number of years, so an associate. Hart had profits for the year ended 31st of March of 20 million, which can assume to be accrued evenly since then. So, that's in this year. So, let's just put that in then. We know that the post-acquisition then, this investment in Hart, they have made at least 20 million in the post-acquisition, times by 25%. So far, so good. Hart does not have any other comprehensive income. Okay. On the 30th of September 2016, that's halfway through our year, they sold 10% for 42 million. So halfway through the year, what I've put here, 30th of September, halfway through the year, they sold it. Okay, and they sold it for 42. All right, well, they sold 10% at least. Keep going. They're unsure how to treat the disposal, and so at the moment they've deducted it from the carrying amount of the investment, which was 110, calculated using the equity accounting method. So it was 110 at the start of the year. So, getting somewhere now. At the start of the year, the associate was worth 110. I now know for 6 months it made 20 million, of which they'd have got 25%. So you've gone 20 times by 25% divided by 2, basically, isn't it? 2.5. So 112.5. So that 2.5 needs to go to our retained earnings. It goes to the income statement, so it goes to retained earnings. 2.5. Okay, so 112.5 is our associate. Yeah, let's just keep going then. Let's see what else he has to tell me. The fair value of the remaining 15% was estimated to be 65 at the 30th of September and 67 at the 31st of March. So he's telling me the fair value at the 30th of September was 65, and at our year end it was 67. Okay, so we're getting somewhere. Now I just want to know how they're treating it really. How are we going to treat this? So it's no longer an associate because they no longer exercise significant influence, and so they've designated it as a fair value through OCI. Okay, so from here on in it becomes a fair value through OCI. So that 2 difference there will go to the OCI, will go to other reserves. So let's start doing the other reserves then. So I'm going to add on 2 because I know that should be 2. So D's other reserves are 128. Other components of equity. 128. So that comes to, excuse me, 130 so far. S's are, go to their equity table, and it's that 14 if you remember. So we deserve to get 14, we need to get 70% of that 14, which is 9.8. And Club has none, look, no other reserves. So that's the other reserves bit done so far. I just wanted to do it because otherwise I'll forget that. Okay, and 67 is what I'm going to put it in the balance sheet at, because there's a fair value through OCI. So I may as well go straight to here and say, right, this is a fair value through OCI. You could, in fact, include it in other financial assets, couldn't you? But anyway, I'm going to put it separate, 67. Okay, so what is it that I've done here then? You know, let's get some double entry going here. I've received some cash. 42. I'm getting rid of my associates, 112.5. Okay, I'm now putting in a fair value through P&L to begin with of 65. I've dealt with the other two already. And therefore, that should be a debit, shouldn't it? 65. And so therefore, I've got another debit left over of 5.5. So that must be the loss on the sale that I've made. Okay, so a loss on sale, where are we going to put that? Retained earnings. Income statement. And so therefore, retained earnings. And I think we've dealt with everything that needs to be dealt with there.